I'm going to work through this question now. Moorsel Ltd, which was from the ACCN3 paper back in June 2016. It's quite an unusual one in that they've given you a partially completed statement of cash flows, and it's quite tricky. There's an awful lot of calculations that need to be done, from depreciation to bonus issues, rights issues, so dealing with the number of shares. So it's quite a useful recap for some calculations other than just for the statement of cash flows. So let's just have a look at what we're given then. They've given the following extract from the balance sheet, which obviously is the statement of financial position at the 28th of February 2015. Now, if we just glance forward to what we're being asked to do, we're actually being asked to complete the statement of cash flows for the year ended 29th of February 2016. So these are the opening balances. We've got details of the non-current assets there, the cost, the depreciation and the net book value. We've got the corporation tax that was outstanding at the beginning of the year. The debenture loans, 8% debenture loans, so that means 8% of interest will be paid on those loans. 120,000 outstanding at the beginning of the year. An ordinary share capital worth 150,000, but it doesn't tell us at this point how much each of those shares is worth, so we'll need to think about the number of shares in a moment. So let's just go through the additional information and think about why we might have been given that, how it might be useful, why we might have been given it. So first of all, a non-current asset was sold on the 31st of May 2015. It had originally been purchased on the 31st of December 2013 for 22,500. So we know that with non-current assets, we need to work out whether there's a profit or loss on disposal. That goes in the operating activities section. We also need to work out what the sale proceeds might have been. That will go into the investing activities as an inflow. So we're going to have to do something with that. We're also going to need to know potentially the net book value, so we might need to work out how much depreciation has been provided on that asset to date. Okay. Ordinary shares have a nominal value of 25p each. Okay, so we need to divide that figure by 0.25 or multiply it by 4 to get the number of shares. So that's actually going to be 600,000 shares. Tells us that a bonus issue was made on the 31st of March 2015 on the basis of 2 for every 5 shares held at that date. So remember, if we've got a bonus issue, we convert that 2 over 5, and then we multiply that by the existing number of shares times 600,000 shares. So 2/5 of 600,000 is 240,000 new shares at the nominal value of 25p. So 0.25 gives us £60,000 worth. So we're going to be increasing share capital by £60,000. But remember, we'll be taking that out of other reserves. That won't actually raise any cash. But we do need to know how many shares we've got, because there's a rights issue coming up next, which will give us some inflow of cash. So we've got 240,000 bonus shares to add in there. And then it tells us that a rights issue was made on the 31st of May 2015 on the basis of 1 for every 3 shares held at that date. So that's going to be on the basis of the 840,000. So 1 for 3, so convert that to a fraction, 1 over 3. So we've got 840,000 at the moment. So a third of that, 280,000 new shares. And they're being sold at a premium of 15p. Well, the premium is added to the nominal value of 25p, so we're actually selling those for 40p each. So if we think about the cash that's being raised, 280 times 40p is £112,000. Okay, but we've now got an extra 280,000 shares. So 840 plus 280 means that we've got 1,120,000 shares now. So in case we need to work out a dividend, that's the number of shares we've got. So as if by magic, here's the dividend part. So an interim dividend of 5p per share was paid on all shares in issue at the 31st of August 2015. So that includes these two. So we need to do a dividend of 5p a share. So convert that into a pound amount, 0.05, and times it by the 1,120,000 shares. That's the figure we've got here. So the 600,000 we had at the start, plus the 240,000 bonus shares, plus the 840, which is 840,000, then plus the 280 that we did the rights issue for, is a total of 1,120,000. So let's just multiply that up. It gives us a dividend of £56,000 paid out. Okay, so that was received, the share issue. Remember, that's going to be an inflow under our financing activities, and the payment of dividend is going to be an outflow also under financing activities. Okay. A non-current asset was purchased on the 1st of June 2015. In a minute, a debenture loan was repaid on the 30th of November. No other repayment of debenture loans took place, so we haven't got the information about that there, so we'll look elsewhere in the question for that. We've got some details about tax on profits was estimated to be 22,880. That's the income statement figure. And then the tax liability at the 29th of February was 19,340. So that's the amount owing. We've got the amount that was owing at the beginning of the year. So we're going to probably try and find tax paid. We're going to need that. So if we start with the tax liability at the start of the year, plus the figure from the income statement, 22,880, minus what's owing at the end of the year, 19,340, and that will give us the tax paid. So 16,250 owing at the beginning of the year. We owe them 22,880 for the current year down here, and we still owe them 19,340 at the end of the year. So we take that off. So that means we've paid £19,790. Okay, that's the actual tax paid during the year. And then the depreciation policy, all non-current assets are depreciated using the straight line method at a rate of 20% per annum, but depreciation is charged on a time apportioned basis. So that means we do need to work out any depreciation. We have to do it month by month. Now, with this question, it was spread over numerous pages, and some students didn't notice that a couple of pages in, probably 3 or 4 pages in, there was a partially completed statement of cash flows. So what they were asking you to do was calculate depreciation for the year. We do need to work that out. Calculate the profit or loss on the non-current asset disposal. Calculate the interest paid, that's on the loans, debentures. Calculate the income tax paid, that's what we've just done. Calculate the proceeds from the issue of share capital, and calculate the dividends paid. But if we go over onto this page, you can see that we've already got some figures. They've already done dealt with the inventories, the trade receivables, and the trade payables there. They've got details of the purchase of non-current assets. So 75,000 is an outflow. And if you remember here, they gave us some information about the fact that it was bought, and it was £75,000. Okay, so quite why they decided to do it like this, I don't know. I think it was not particularly fair the way the question was laid out. They've got sale proceeds, so a non-current asset was sold for 16,500. So let's put that in there, 16,500 sale proceeds. We're going to need to work out the profit or loss on disposal, but before we do that, we're going to need to work out how much depreciation has been applied. So we're going to have to do some calculations on a month-by-month basis. Other information they give us, a debenture was repaid, £100,000. So we can pop that in there, £100,000 repaid. So that means we owed £120,000 at the start of the year, but partway through the year, 30th November, we've repaid £100,000. So when we're calculating the interest that was paid during the year, we're going to start with the £120,000 at 8% for the first period of time, and then that's going to drop down to the £20,000 that's left. So that leaves £20,000 outstanding for the second part of the year. What else are we given here? I think that's pretty much it. So cash at the beginning of the year was 4,200 overdrawn. They haven't told us what it is at the end of the year, so these are going to have to be balancing figures. That will be the result of adding all of this up, and the cash at the end of the year. We can't double check that because we haven't got the statement of financial position at the end of the year. And as if that wasn't all bad enough, Part 4B was another 15 marks to assess the performance of Van Moorsel based on the statement of cash flows for the business for the year ended 29th of February 2016. So if you hadn't had a very good go at this, then you'd be a bit stuck with trying to assess the performance. So yeah, quite a nasty question. I suspect probably wasn't done all that well in the exam. So let's start working through the calculations. Obviously, we've made a bit of a start on them here, but the first one it's asking us to do is work out the depreciation charge for the year. Now, I would suggest we probably need to deal with the profit or loss on the non-current asset disposal before we try and work out the depreciation. So let's deal with this one first. So the asset was bought, it tells us that here somewhere. A non-current asset was sold on the 31st of May 2015. It had originally been bought on the 31st of December 2013 for 22,500. So 31st of December 2013. First year end we would have had it would have been the 28th of February 2014. It was there for the whole of the year ended 28th of February 2015. And it was only there from the 1st of March 2015 up until the date it was sold, which it tells us here, the 31st of May 2015. So we've basically got January and February, so 2/12 of depreciation there, full year of depreciation there, and March, April, May, 3/12 of depreciation there. So there's not really an awful lot of space to do all of this. So 2/12 times the original cost, 22,500, times 20%. So 2/12 times 22,500 times 20% is £750 of depreciation. Year ended 28th of February is on the whole lot, 22,500 times 20%. 22,500 times 20%, which is 4,500, and then 3/12 times 22,500 times 20% for the last little period there, 1,125. So I'm going to be really naughty here and write outside the margins. I'm not planning to send this off anywhere for marking. So the total depreciation on that asset was 6,375. So the cost was 22,500 minus 6,375. Okay, so that gives us the net book value, which is 16,125 net book value or carrying amount. The sale proceeds, if you remember, were given to us somewhere here. So it told us about the sale proceeds there, 16,500. So that's the proceeds. So that means we've actually made a profit of £375. So that's the profit on sale of non-current assets. We could actually include that. We could pop that in here. So profit or loss on disposal of the non-current asset. Remember that needs to be deducted. A profit on disposal will have increased profit, but it won't have an impact on cash. So we need to remove that, take it away from the profit from operations. Okay. So now that we've done that, we can work out the depreciation for the year. Because it's on a month-by-month basis, it's going to require 3 separate calculations. We're going to want to include the depreciation down here on the asset that's been disposed of, depreciation for part of the year on the asset that was bought during the year, and then a full year's depreciation on assets that have been there all year. So the depreciation is the same when we do it with the schedule of non-current assets. It's going to have 3 components, unfortunately, when it's a month-by-month depreciation. So we've got depreciation on the disposal. I'm not going to go through all that again. We've just worked that out, is 1,125. Depreciation on the addition. Okay, now let's see. We're told on here that we bought a non-current asset. It cost £75,000. Let's have a look at when we bought it. So let's go back to this original piece of information. So a non-current asset was purchased on the 1st of June. So we've got June, July, August, September, October, November, December, January, February. So it's 9/12 into the year. So the depreciation is going to be 75,000 times 9/12 times 20%. 20% times 9/12 is 11,250. And then the assets that were there for the whole year is the remainder. So it's the brought forward. So it's the 265,000 minus the cost of the one that was sold, if you're still with me. So if we look at the disposal calculations, the original cost of that one was 22,500 disposal. So 265 minus 22,500 means that we've got 242,500 of assets that were there all year. Okay, so we can do a full year's depreciation on those, 20%, so 48,500. So they've given us far more room than we need on this question, but nowhere near enough room on the disposal, bizarrely. So in total, the depreciation charge is going to be £60,875. Okay, so that needs to go into our statement of cash flows. I'll put these in as we're going along. So depreciation, remember we add that back because depreciation will have reduced the profit for the year, but it doesn't have an impact on cash, so we need to add it back, whereas the profit on disposal would have increased the profit from operations, but it won't have a bearing on cash. So remember, these are non-cash adjustments. A profit or loss on disposal is simply adjusting for either providing, in this case, too much depreciation, or in the case of a loss, not enough depreciation. Remember, it's the proceeds that we're interested in. This is the inflow and outflow. Outflow when we buy assets, inflow when we sell them. Okay, right, let's have a look at the interest paid. Let's move this up a little bit. So the interest paid, we've got some information here. We owed 120,000 of debentures at the start of the year. We're paying 8% interest, but partway through the year we did a repayment, didn't we? So the debenture loan was repaid on the 30th of November. So March, April, May, June, July, August, September, October, November. First 9/12 we owed all of that. But partway through the year, we repaid £100,000. If you remember, that was given to us all the way over here as an outflow under the financing activities. So I suppose at least one benefit of this question is that you don't have to remember the layout, but there's an awful lot of rooting around for information. So the last 3/12 we only owed £20,000 because we'd repaid £100,000. So 3/12 of that. Oops. So let's work those out. 120,000 times 8% times 9/12 is 7,200, and then 20,000 times 8% times 3/12 is 400. So we've actually paid a total there of 7,600. If you remember, that's going to be an outflow in this top section when we're trying to come up with the net cash from operating activities. Interest paid is an outflow. That was 7,600 there. Okay, so that's that page completed. So income tax paid, I've already gone over this, but we'll go over it again quickly. So 16,250 is what was owing at the beginning of the year. Add on the charge from the income statement, which was down here in point number 8, and take off also in point 8 what was owing at the end of the year, 19,340. Means that we've paid tax of 19,790. So I'm just going to put the total in there, which is a bit naughty, not putting it in the space provided. But the income tax paid there, so it was 19,790, is going to be an outflow in the operating activities section. Okay, so net cash from operating activities is going to be the sum of all this lot. So 114,390 plus 60,875 minus the 9,400 minus 12,600 minus 7,800 minus 375. Remember, we've got a subtotal here. Cash from operations is a subtotal, so 145,090. So that's the cash we've generated from our operations before we've paid any interest and any tax that are due. So we now take those off. 19,790. So our net cash from operating activities, it's a positive figure. We've generated £117,700. Okay. Now we don't need to do anything else in the investing activities. We've got the purchase of non-current assets is an outflow, so minus 75,000 there, plus 16,500 there. So overall net cash used in, it's an outflow, 58,500 there. Okay. Then we've got the proceeds from the issue of shares. Now, if you remember, I went through all of that before. So although we have got space here, I'm not going to go through it again. If you need me to, or need to work out where this has come from, rewind the video. But basically, we issued shares. We'd already piled the bonus shares in there. And then we worked out that we were issuing another 280,000 shares. And they are being issued at a price of or a premium of 15p a share. So the total price per share is 40p because we're adding that to the nominal value. So we've actually received £112,000 from the share issue. So that's an inflow of cash. And then the dividend paid, did we work that one out? The dividend paid was here somewhere, 5p a share. So it's based on all the shares in issue at that date. So 1,120,000. We paid a dividend of 56,000. So dividends paid 56,000. So 112 minus 100 minus 56 means we've got net cash used in financing activities, £44,000. So our net increase or decrease in cash is the total of these three. So we've got cash generated from or by operating activities, 117,700. Let's type that in correctly. Then we've got 58,500 used in our investing activities, so that's a negative. And then we've got also used in financing activities, 44,000. So overall, we've increased our cash by a total of 15,200. Cash at the beginning of the year was an overdraft of 4,200, so we take that off. Means that if we looked at the statement of financial position, that should be the cash and cash equivalents figure at the end of the year. Okay, so that is the number crunching part done. 4B is assessing the performance based on this cash flow. I'm going to record a separate video on that because I think that warrants an extra video tackling the written part. But hopefully that's given you some guidance as to how all these figures have been arrived at. This is possibly the worst question we've had on cash flows in quite some time, I think mostly because of the way it was laid out. But anyway, if you've enjoyed this video, don't forget to like and subscribe and watch out for future releases. Thanks for watching.